so much for joining us today and welcome to our webinar. We're thrilled to have you here as we are about to explore a truly remarkable investment opportunity today. My name is Laura Nieves. I am head of investor relations for Astor Realty Capital. We are an institutionally backed private equity firm guided and led by seasoned professionals with tested market cycle strategies. Our approach is fairly simple. We invest smart capital into top-notch real estate ventures with relatively short durations to nurture and safeguard our partners' investments. At present, we proudly participate in a portfolio of $3.65 million, 3.65 million square feet and $2.27 billion of assets across 12 submarkets that deliver returns that consistently outperform industry averages. So before we dive into the specifics today, I would like to introduce our esteemed CEO and host for today, Joe Berko. Joe is not just a highly respected entrepreneur with over 25 years of triumphs in the commercial real estate finance and investment banking industry. He is also a source of inspiration for many. His incentive methods in securing and closing substantial commercial transactions have earned him numerous prestigious awards, such as Power Broker by CoStar and New York Signature Broker by Globe Street. He's a passionate advocate for giving back, and Joe serves on the board of several nonprofit organizations, and he is often invited to share his wisdom at professional conferences and, in more recent days, podcasts. You can catch them on our website. So today, Joe will dive into our newest rental development project, which is in one of Brooklyn's most coveted neighborhoods of Williamsburg. This investment is anticipated to yield an impressive 21% annual return net of fees, and the project duration is capped at 42 months max. The developer is providing a personal guarantee on the amount invested. So without further ado, it is a pleasure to welcome Joe Berko, and he will shed more light on this investment opportunity. The stage is yours, Joe.
Thank you very much, Laura. Very great to see everyone. It's been quite a while. In fact, about 14 months since we've reached out and shared an investment opportunity, and not for any reason other than, there's a syndrome called the fallen knife, and we don't want to be the ones catching a fallen knife too close to the bottom. And so we've had to employ discipline and put our thinking caps on, and we've decided to wait. And we've been looking at the market. We've been observing how things have been trading and changing, and we looked at how the Feds have been eroding real estate values, and we feel that this is now our time to enter back in. Let's have a couple of moments chat before we'll go into the investments. I know we have a lot of folks that are eager to invest, certainly eager to put money back into the market, but let's just have a very quick overview of what we have going on for us right now. So high level, if we look at the market, we're looking at the peak of the market being March of 2022. At that particular time is when interest rates have started to slowly, or maybe should say it differently, maybe quite quickly started to come up. The Fed's mission was to curb inflation. At the time, it was 8.5%, and was showing all signs to become a very quick double digit. And that would obviously not be a good thing and would cause big economic issues to all of us. It's sort of like a global phenomenon. Most of the Western world has been experiencing that for the last several years, obviously due to the pandemic and obviously due to capital flushing the markets. And so it was certainly inevitable. And so, whether you believe that the Feds have done the right thing by, increasing inflation in such a tremendous pace, we have not seen those type of a pace of increase of interest rate or not. The fact of the matter is, we decided to pull back from the market and to wait and see. So we our team entirely go through about 800 transactions. We're very proud of that number. Roughly 800 transactions, 800 requests throughout a typical year, where our team is being asked to participate in projects as as partners. We have 3 strategies. As Laura mentioned, we either participate as joint venture partners, or as common equity partners, or we deploy capital through debt, right? So these are the 3 strategies that worked fairly well for us, considering, how the world has gone for the last 3 years. We've done extremely well, particularly well. So I'm very proud of the work that my team has been doing and Astor in general has been doing. It certainly wasn't easy times. We're averaged around 23% a year. It certainly was not easy times. And so, I think we fared really well during those years. And certainly, if this was a test, I think the team has done good. But considering this environment right now, so now we're sitting on the sidelines. Most of the deals that we're seeing are priced as if the deals were done yesterday. And we just couldn't see the price break. We couldn't see the realization the world has changed, that there's a higher cost of goods, that there's higher cost of capital. Interest rate have obviously immediately, as a direct correlation of the rise in the Fed's interest rate, we started seeing a rise in interest rates throughout the lending world. And so all of those things have been affecting real estate and have eroded values. Looking now into where we are today, we're looking into 14 months. Now, the world has changed to some extent, right? Inflation, first of all, has dropped to about 5.5%. And while the Fed is still trying to, at least some members of the Feds believe that they will bring inflation down to 2.5%, which I highly doubtful. We are seeing that this is kind of like the worst is over. The increases are now slowing down, and if there is going to be more increases in expansion, so it's going to be very slow. But we're certainly looking at the very bottom of this, the very end of this. As I mentioned, inflation is down from 8.5 to 5.5, and we believe that so long that we have reasonably good employment stats, so long that those will remain, we're probably going to stay at somewhere in the vicinity of 4.5% is where inflation will settle. Interest rates will slowly will come down as well. Other factors that are certainly directly affecting cost of capital, cost of our of production. So where a lot of what we do is in development space. And so a lot of that is actually starting to stabilize. We're actually starting to see cost of goods coming down, cost of labor coming down. If you think about year over year, January over January, labor statistics inform that new construction starts, which we track very, very carefully, new construction starts have dropped by about 50%. So if we are looking to build something, there's a conversation into the future. We're always trying to figure out how things would look like in 2.5 years when our project will be done. Are we going to be saturated with too much product? Is there going to be not enough product? And where are we in the market? So we spend a lot of time thinking about this, but certainly a slowdown in construction starts makes it appealing for us to start looking back into projects. And so that's exactly what we're doing. The particular investments that we are going to be discussing in a moment or two, I think also is designed to sort of like curb the risk associated with conducting business in this particular time. And the fear that's out there, right? The conversation, the fear, the unknown. There's a lot of capital that's sitting on the sidelines. Banks are pulling back. Banks have tightened underwriting. And so all of this is just those signs that we're looking for to understand that we're looking at the bottom. Of course, we'll never know if we reach the bottom. Everyone's a Monday quarterback, and we'll always know in hindsight. But look, I've been around the block for about 28 years right now, probably went through about 5-6 different cycles. It feels like it's the bottom. So we're very happy to enter back into the market. Having said all that, Laura, if you can please put up the presentation for us to begin. Thank you. So in this particular deal, it's about 5:12. I'll try to finish sometime in the next 20-25 minutes. I'll leave some time for questions if anybody have questions. And of course, shoot Laura a text or shoot her an email if you have any questions and you want me to address those personally. I'm happy to do that as well. So in this particular deal, we're looking to enter into a 4th project that we're doing with a great partner that is building. This guy's been building for the last 25 years in Williamsburg, Brooklyn. Okay, that's almost exclusively where he builds. And We're essentially stepping into a project that have commenced about 1.5 years ago. This is a 50-unit residential rental building with 5,700 square feet of retail in a great location in North Williamsburg. Those who are not familiar with the area, I want you to consider that, you know, if the epicenter of art, nightlife, galleries, restaurants, coffee shops, young vibe environment, now lots of more office space and everything else is now have moved quite substantially from parts of New York City into parts of Brooklyn. Brooklyn has used to be sort of like you couldn't afford to live in Manhattan. You would take the subway and you would drive out to Brooklyn because it used to be a lot more affordable. And there was a second choice location for most individuals. Over time, Brooklyn became a lot more appealing. I've gotten a lot of attention of everything that I've mentioned from young and artists and families that moved down there. Brooklyn became more expensive and more in demand. Today, you know, certain parts of Brooklyn, Williamsburg, for example, is a good example of that. Today, if you live in Williamsburg, it's considered a status, right? There's Williamsburg, for the most part, is more expensive than Manhattan as a comparison. You know, and so folks that are building there are building smaller units, you know, usually rentals, smaller units, and they tend to go for very expensive dollars, which we will see here today. So our investment here is to participate or to buy into an existing project. You can see the picture at the bottom. This is a current status of the building. We're topped off. We're buying 77% into this project at cost. Cost is, in this case, it's $46.79 million. The developer that have infused initially $18.7 million is going to repatriate about $14.5 million from us. We will own 77% of the project. And we're soon to getting this project stabilized, at which point it will be fully leased with the retail in place. The location is fantastic. And we're very excited about this project. And so what we're doing today is essentially we're raising $14.5 million in order to buy this position. We already have a commitment from an institutional group, a very large institutional group with worth about $50 billion that is committed to $12.5 million. And so what we're offering today is our GP position, right? Astor Realty Capital is the GP of this position of this structure, and we're offering investors to participate with us in our GP position and to enjoy very lucrative returns. What we love about this project, essentially, is beyond its location, is the fact that we're dealing with a developer that we have good experience with. This is our fourth project together. The other two, we've had two exits. Both have happened ahead of time, and we've hit the numbers. And our investors, those that are familiar with South Side units, those that are here now that investing, looking to invest with us again, are certainly very happy to do it. And so what we've done is we've created a preferred return structure, which I'll talk about in a moment as well. And so why are we effectively excited about this opportunity? So there's a preferred return, which means our capital will come out first before our partner, our developing partner, capital will come out, right? So first will come the bank, then will come the preferred return of the capital that we are invested. Then only then we will get our returns that and then the capital for the developer. The duration is 36 to 42 months. It's kind of like mid-range where we typically do deals. We like to be somewhere in the 2.5, 3.5 years. They sort of fall right there. We're getting a personal guarantee on our investment, and that's something that it's quite rare. It's quite rare. So we're not a bank. There is no reason to get a personal guarantee, but yet we're getting a personal guarantee from the developer. He's super confident. It's a group that's been around the block for many years, got very deep pockets, great credit, and we're very, give us a great level of comfort. The location, as I mentioned before, is a highly desirable North Williamsburg, and the track record of the developer is about 25 years, over 80 projects that were done successfully. And So for an example, as I said, we're raising $2 million. The last $2 million, some of that capital will be our own, the principals of Astor and our associates. And from our friends and family, we're inviting you to participate. A minimum investment is $50,000. Every investor has the responsibility to pay up investor participation fee. It's 5%. So if it's in this case, in this example, if you invested $100,000 with us, it will also be with an additional $5,000 for us to what we call keep the lights on, pay their bills and pay our salaries and make sure that we're able to service the investment for the next 3 to 3.5 years. Okay, so that's something that's very important to us. In this particular example, we're looking, as I said, at an investment of $100,000, including a $5,000 participation fee, assuming 36 months. There is also a potential for an extra 6 months extension, but assuming 36 months in this case, an investor will generate $67,359 when capital is returned. An annual will be around $22,453 per year. And the due back will be $167,000, meaning $100,000 plus $167,000 back. Annual return after our fees net of all expenses will be 21.38%, and the total return on percentages wise for 3 years will be 64%. I'll share with you, for those who are interested, I'll share with you how we derive to this amount. But I'll take you through the high level, and please focus on the upper left corner of what it is that we're doing. So we're in fact giving the developer our capital, $14.5 million at the tune of 19%. Okay, so we're giving the developer 19% on $14.5 million. Our institutional partners are going to be receiving 17.25% of that amount. Our $2 million, our GP capital, $2 million that we'll be raising in order to infuse to this project will in fact enjoy the total amount that is the benefactor of the difference between the 17.25% and the 19%, which will generate for us just shy of $600,000. And once you do the math, you're looking at close to 30%, 29.94%. After we collect our fees, promotes, it will generate to the investor 21% a year. I don't want to dive too much into the numbers, but certainly you can take some time. And if you have any questions, take a look at this. We're breaking it down here very easily, very carefully. We're going to be taking a 25% promote. And so, so altogether, the return will be moving down from 29.94 to the investors, 21.38%. Again, to reiterate the business plan, we're coming in with $14.5 million. 12.5 of that has been committed. The last $2 million is starting to get committed. Some of that capital will be our own, of course. And what we've designed here, the way to make payments is every 12 months, we'll make a distribution to our investors. Okay, so you don't have to wait 3 years or 3.5 years to see capital back. Every 12 months, you're going to get 21.38% return. And that's just how we have it designed. In terms of a rollover, now, because those projects are short, and those of us that have participated in a project with us in the past with the very same developer, we've allowed the developer to do what we call the rollover. So once every or up to 3 times during the next 42 months, the developer can finish a project, pay us back our interest, and ask us to roll over the investment amount into another project. Okay, so roll over from one project into the next with similar characteristics. So in other words, if we're investing right now in a rental or a mixed use, and it's located in a great location in Williamsburg, and North Williamsburg, and it has all those fundamentals, we're going to be looking for a similar size project. Now, if we choose not to do the project, we can always say no, and we can always repatriate our capital back, our investment, and get our return. So far, as I said, this is a 4th project. We're very, very happy with the developer. I don't see a reason why we'll not roll it over. And so that's sort of like how we're running it. In terms of project timeline, as I mentioned, the development itself started in September of 22. That's when the site was acquired. We're entering now in July 23. So I think we'll close in the next 30 days. So if you're committing today, you'll get a letter from Laura or from one member of the team to the amount that you're committed. And then in the next 3 weeks or so, I expect that all compliance letters and all the operating agreement will be done. And then we'll ask for capital to be deployed for the investment roughly within 30 days from today. We anticipate that TCO and stabilization will happen somewhere in the next 6 to 9 months, at which point, there will be cash flow either through refinance or through the rollover. We're going to start seeing the 1 year annual return as we go along. Okay. And then, of course, our exit, if it's 36 months, will be July of 26. The developer still has 6 months option if he chooses to take one. That is available to him. Again, sources and uses. This project was acquired. If you look at the uses part of this transaction, land was acquired for $13,750,000. There was also some air rights from neighboring sites that was acquired in order to make this a larger property. Hard costs, contingencies, soft costs, everything else combined comes out to $46.768 million. The sources are senior loan from Banco Popular for $28 million, representing 60% of total cost. Preferred equity is $14.5 million. The developer equity will remain in the project is $4.268 million. Again, total sources, total uses are exactly the same, $46.768. To the right side, you can see a visual presentation of what it is that we have between senior debt, our preferred equity position, and the last dollars that are the developer's piece. If you were looking into the valuation of this project, which is a very important factor for us, I mean, we're building a building. What else? What's going to be the value of the asset? And so we're looking at 50 units altogether. We have something called the 421A. It's a unique tax abatement, extremely valuable. Which allows our taxes, our real estate taxes, to sort of like stay in place for the next 25 years. And the last 10 years following that, they will incrementally go up to their full-blown amount. And so in this particular case, our taxes are frozen at $15,000 and change. So $15,000, property like this, fully stabilized, is going to be reassessed. It probably will be around $500,000. So there's tremendous saving. 25 years of frozen taxes at $15,000 makes it super valuable. And then the rest of the years that I've mentioned, it creeps back up. In order to do that, what we're doing is we're giving 30% of the units are going to be affordable. Now, in New York, affordable, it's a conversation in itself. Those of you that are outside of New York, $50 a year in rents, it's doesn't consider to be quite affordable. Actually, it's considered rare luxury, but please understand, New York City is an animal of its own. So let's take a look at this. We have 50 units in the building, 70% or 35 units of free market. They're going to be renting at around $100 a square foot, right? $8.50 a square foot per month, about $100 a square foot. We're talking about small units that are leased out to young professionals, at close to $6,000 per month. The affordable unit, 30% or 15 of those units are going to be leased out at about $2,600 per month. We underwrote the retail at $95 an annual rent, which will generate for us $45,000 a month. There's a little bit of parking. Once we factor in vacancy and so on, we're looking at around $280,000 a month in rent and $3.3 million in annual effective gross income. Running expenses are going to be around $266,000, $267,000. Our projected NOI, stabilized building projected NOI, is $3,097,000, causing us a yield on cost of 6.62%, which makes it super good. There is a good chance that the retail will be rented for more than the $95, but if that happens, it's great. And so essentially, we're looking at whatever the test what we ask ourselves in the event that this building is completed and fully leased and rented. Can we replace the construction loan? And the answer here is at the bottom right. Okay, when we do a minimum DSCR test, debt service coverage ratio test, and so we're looking at around being able to pull out around $34 million, and loan to value is 5.7, and we'll have above the $28 million loan, we'll have a surplus of about $5.6 million. And so the answer is yes. In the event we have to keep the asset, not sell it or not exit, we're able to do it quite easily. Locations I mentioned before, I'm not going to bore you with the gory details, but Williamsburg is a super coveted, I would even say world destination, great neighborhood, tons of nightlife, young professionals, people are fighting to get a space in this market, to lease, to rent, to buy. Prices are more expensive than Manhattan, $1 per square foot. Condominiums are as expensive as Manhattan. There's many reasons why people like to live there. I love this neighborhood. In fact, I lived there in 1994 when the neighborhood was quite different. It was just getting to be grungy and cool, and with all the artistic stuff over there. And it's sort of like the cradle of me with my love affair with Brooklyn. And so I've been following this neighborhood. We've had quite many investments in those neighborhoods in this area, and we're very happy with this. Rent comparables. So we always want to know what are the buildings doing, and so I'm not going to take you through much to it, but there's enough of a data here that we've done to look at other comparable properties at similar square footage, similar buildings, right? When we're doing comparables, we call this a boutique size building, it's 50 units. We don't compare it to like a high rise with, 60 floors and views until forever and golf course simulators and gyms and circus on the roof, or something that has to be somewhat similar. We'll compare apples to apples. In this case, brand new luxury product, however, a boutique product with limited amenities. And so those are the buildings that we've chose. The numbers are quite exactly where our essentially our developer is projecting. A little bit about our developing partners. I mentioned Southside Units. They've been around the block for well over 25 years. Only building Brooklyn. They're vertically integrated between their ability to do construction management, to do building management, asset management, leasing. They're super laser focused, and we love this. We love this when we have folks that are sort of like playing in the one sandbox, in the one or two, three neighborhoods or one borough. It's quite amazing for us, because you just get to know, you get to know the folks that are in charge of, zoning and if there's any changes and how to work with them. It's just sort of like, what we're looking for. This guy has today about over 1,600 apartments. These are the two projects we've exited fairly recently. We've done really well. We are sharing here the sponsor track record, which is quite amazing. I think it's a story in itself. To the left, you can see all the buildings that he either bought, acquired, sold, held, his positions in those buildings. This is obviously confidential information. When we share with you the information, we know that you will not share it with anybody else for other than the purpose of, doing your own due diligence, right? You got a lot of good stuff here, all concentrated in one borough. And what we looked at is to see how strong is the personal guarantee, which is quite rare to get a personal guarantee. It's quite a rare thing here. And so we have a group that is now sitting on a $1.2 billion of real estate assets. Some of them, they have partners. And so we had to bifurcate the sponsor, the operating partner's position from those of his partners to understand really, truly what his valuation is. His proportionate share of those assets is around $500 and change million. And once you bifurcate still the mortgages and all sorts of debt, you're left with about 150, 160 million of net worth. And that's quite substantial. So we love the credit. If you remember, I used to say, before we choose a project, we look for the triple C, right? The triple C, the collateral, the real estate. We obviously understand the real estate. We love the real estate. We love the location. The the credit, right? To how financially solid this individual is, and of course the character. Well, the character, it's an easy person to work with. We're able to work through any surprises and any issues that sometimes creep up during construction, work through them quite easily, make decisions fast, and continue moving on in order to produce the type of returns that we're expecting. So, we have a great working relationship, and I'm very happy with that. That's pretty much about the investment itself. To summarize, we have an opportunity to enter a project that is far advanced, a developer that is highly experienced with a great reputation and a great character. We have an individual that is been working in the same sandbox for over 25 years, have done multiple projects. We were lucky enough to do 4 projects with him at this stage, and we've had 2 of them exited. On top of it, we have a personal guarantee, and it's a personal guarantee, which means that your capital, your investor capital, is guaranteed to return by somebody that is worth, in our opinion, well north of $150, $160 million. It means a lot. It's quite rare. This is not something that we get in projects, certainly not in projects where you can make 20% or 21% return on your cash invested. On top of it, we have an institutional group, a $50 billion institutional group that is coming in with us. Those guys are no joke, right? They do their due diligence, or we do our due diligence. We're talking about some pretty intelligent minds that are going into these transactions. And I got to say, we've had a lot of interest. We went to some very large groups. We've had a lot of interest. These are guys that we know for quite some time on a personal level. And we're happy to do our first piece of business together. And so this is why we love the project. I hope you see what we see, and I hope you'll take the leap of faith and come in with us. A little bit about Astor Realty Capital before we sum up and open up for any questions. So why Astor? So we've identified 5 areas that we feel are important to us and important to our investors. I think the first thing is it's nice to make returns, but preservation of capital, it's extremely important. We work very hard for our money. I've been around the block for 28 years as an advisor. And, we bring all this experience to you. But the most important thing is preservation of capital. How we protect our investors' capital, how we protect our own capital is sort of like the secret sauce of what we do here. And we take whatever measures and whatever steps necessary in order to choose investments that are not just high yielding, but also we're able to sort of exit from them if the worst should happen, right? And that is why following a period like we've had for the last 36 months, we're still doing above average return, which we're very proud of. Ongoing asset management. We don't just finish a project. A lot of folks have spoken to me about investing with all sorts of crowdfunding sites. You go to the website, you click here, you send the money there, and you get this and you get that. We don't believe that that's the way to work, certainly not in real estate. We believe in trust, but verify. Trust, but verify. We have teams of individuals, professionals that are there to make sure that the project is on time and it's on budget. And if not, we step in. We have all sorts of stepping in mechanism, removal mechanism of our sponsors if they're not doing the right thing, and making sure that everything is on time and on budget. So the ongoing asset management is extremely important for us. We are not just kind of like an allocator of capital. We're not syndicators. We're in it with you. We represent you, our investor. You are essentially our partner, and the collective. We gain the bargaining that we're looking for and all the control rights that we have. Above market returns, I did mention several times, we're doing around 23%, never lost a dollar. And, considering the last 3 years, it's, quite commendable. Alignment of interest. I put my own capital alongside you. My capital has the exact same level of risk as you. Our family money goes in together as you. My wife's money goes together with my mother-in-law's money. My kids' capital goes into it. I always make sure that they invest. If it's $1,000, doesn't make a difference. They come in together. We have alignment of interest. We are taking the exact same risk that you are taking, and it's a personal approach for us. And what I mean by that is we always want to know who you are. It's eventually, as a group, we rely heavily on institutional capital that comes in with us to all of our projects, and we always allocate the last 15, 20%, 25% to our own capital, and that is our friends and family. And therefore, this is personal for us. We'd like to know everything that we can about our partners, our investors, and understand them and make sure that they understand us. So we don't manage, thousands of investors and everyone puts in $5,000. This is not this type of an operation. We take it very personal. And you always have access to me, the CEO, we have access to our COO, and so on and so forth. Again, I'm not going to bore you with the details. I've been around the block, as I said, quite some time. Over 25 years, in fact, over 28 years at this point. You can always find more information about me and all sorts of, high points of my career. And, what I do from passion. I love what I do. I love working with our team. We have a great time. We have a great time together. We fight the good fight, and we do good. We do good as a collective. And I certainly hope to continue doing good for many, many more years. We have amassed quite an impressive portfolio with over 3.6 million square feet. Today, we're a national company. We're investing in 12 major markets, 7 states. Our projects are, as I said, are either through debt, through equity, or through preferred positions. You can find our projects in New York City. You can find our projects in Miami. You can find our projects in parts of Florida. Many different states, many different projects, and we keep on growing. I think that's essentially it for now. If there are any questions, I'm happy to take them. Okay.
I don't believe, Joe, we do today. I think that you covered it, but as Joe said, he is available to answer any questions that you may have post webinar. Joe is always very happy to speak to any of our investors, and you will see this QR code on the screen. This will take you to our investor portal where you can give me a couple of minutes to end the webinar, but I will be uploading this investment memorandum there, and I will also share it via email, and I will also share the recording so anybody can refer back to Joe's conversation, re-listen to it, address some things you may have, and so that will be available in the next few minutes. Oh, Joe, we actually do have someone who raised their hand and would like to have a chat with you. Let's have a look. Give me 1 second. Oh, no, that might be I think that might have been an error, unless you would like to have a chat with your son Maxwell.
Yeah, no, Maxwell is our investor as well. Max is 16 years old, is maybe our future CEO. We'll see. He's got many years to go, but go ahead, Max. Do you have a question or comment?
Yeah, I wanted to know why the developer is giving a personal guarantee on the investment.
Good question. The answer to this question actually relies on the deep end of the pandemic. In 2020, the developer reached me, and we've had a discussion about capitalizing one of his projects. It was certainly very, very tough times for everyone. Certainly for a developer who's looking for capital on a large project. It was 227 units that he was looking to build. He bought a great piece of land. He was looking for, I think at the time it was over $40 million. He couldn't find the capital. We knew he was a great developer. We were familiar with the name for many years. We're familiar with the track record. And we've promised him that we're going to do the deal. And we promised him that we're going to find the capital for it. And so we did. We showed up to the table with, first of all, we've done a fantastic deal together. We went out, and what we've done is, not to complicate things, we bifurcated the land. We've created a ground lease structure, sold the ground lease for $30 million and to a third party. And thereby we're able to capitalize $30 million into the project, and then brought another $5.5 million of our own capital, and that is of our partners, to the project. And so it was $40 million that was made available to him. The developer had to come in with about 4.5 and change. We came in with about 5.5 and another $30 million through a bifurcation of land. Now, I know I've used a lot of jargons, but to say it simply, in the worst possible time where people couldn't find money to do projects, we stepped up to the plate. We did exactly what we said we're going to do. But at the same time, we were able to negotiate very strong terms. And one of those terms is we wanted to get a personal guarantee. Being that we were, not being that there was not so much capital available out there, we were able to come up ahead and negotiate those terms. Those terms are in fact legacy terms from the times that there was no capital available in the market. And so we sort of like shook hands, and at that point on every project we've done, the personal guarantee remained. And so that's kind of like how it goes. You make relationship with individuals, they trust what they do, they feel comfortable. In this particular case, I did mention he's a very, very unique individual. Does a lot of projects, small projects, and he feels comfortable to say, listen, if I'm asking you for investments, I'm going to stand behind it. So not only can you take over my project, not only can you replace me, if there is some sort of a loss of capital, I'll step in and I'll make sure that you're made whole. That's quite rare, certainly quite rare. Thank you for asking that, Maxwell. And it's Max is actually calling from Israel. Max is 16 years old. He took a year to study in Israel and is about to finish the year very, very soon. And soon he's going to come back to Miami.
Hi, Max. Very good question. Joe, we also have Lewis McDavid.
Sure.
Give me 1 second to allow Lewis. There we go. Lewis, you have the floor. Are you with us, Lewis? You should be able to unmute yourself.
Oh, great. Sorry about that. Apologize for the background noise, and great presentation, Joe. And it's been great communicating with you, Laura. A quick question: the return estimates, does that factor in the participation fee?
Yes, absolutely. So the question here, let me go back to the presentation. So the question here, if like in our example, individual comes in and let's assume invest $100,000, the investor also has a 5% or $5,000 participation fee. So while the amount that we charge, the $5,000, stays with us, that is not an amount that we return. When we compute the 21.38, we compute it over $105,000. Why? Because you, the investors, has effectively shelled out $105,000. So you want to know what's their return, not only on the investment amount, but also on the amount that you've shelled out on participation. This is why you'll see from $100,000, the actual return is 22.453. Otherwise, it would have been 21,380. Does it make sense?
It does. Thank you for addressing that. I figured that was the case, but that makes sense. And then you said the 5,000 is really just trying to make sure that you can, for lack of a better term, administer this deal and kind of see it through, right?
Yes. That's our keep the lights on fees. So we have all kind of fees that we charge every deal. Investors participate with a certain amount. The deal itself pays us a certain fees at closing. We have all sorts of expenses other than just paying salaries and things like that. But just imagine that that's the fees that will keep us going forward for the duration of this transaction, right? And of course, the promote that we take, right? So you'll end up with 21.38. The total promote is about 29.9, essentially. So we take a small portion of the promote and everything else. We have Irv Brown. Irv, how are you? Always good to hear from you. Irv, did we lose Irv or what?
Irv, you should be able to take yourself off mute and say hello. Okay, we'll come back to Irv. Irv, I'll work on it. Give me 1 second. But we do also have Andrew Grinbaum.
Sure. Hi, Andrew. How are you?
Oh, hey, can you hear me?
Yes, we can hear you now.
Great. Quick question about the participation fee. If I'm using a self-directed IRA, is that separate or can also be part of the self-directed IRA? Like put
No,
in 5,000.
it can be. It can absolutely be.
Sure about- all right.
Yeah, the IRA does not tell you how to allocate deployment of capital.
Right.
Everybody have expenses, so yeah, it should not be an issue at all. If it was, yeah. So if it was for this example, your investment would have been 100,000 plus 5. Your IRA will contribute $105,000.
And one more question. And when are you looking for the funds?
So we're thinking roughly 30 days from today. We still have to complete our operating agreements with the developer. Now we have a working template that we've used in the past, and we all want to work through that, so it will be fairly quick. Once we actually start the raise, before we can take your capital, we have to send you an operating agreement, PPM. Compliance attorney takes about two and a half weeks, sometimes 3 weeks to complete that. You have a full subscription agreement, and which you will sign, and all the documents. By the way, nobody asked me about due diligence. We have a full DD room and full data room. Whatever is available to us is available to you. We have full transparency in that. And if there's anything that you need, additional amounts of information, you can always get that. So we'd like for people to take some time, ask around, call us with questions. Make sure you feel comfortable with what you're seeing, and if you're not, then get on a call with us before you make a decision. So the way we do it is typically we do it through an honor system. As I mentioned, it's a club of friends and family, and now I'm completely aware it's been growing. Friends have been bringing more friends, and it's kind of like organically been growing really nicely. But the way we have it is kind of like an honor system. Most likely, we're going to have more demand than we're able to supply. So in other words, we get fully subscribed fairly quickly, and we have more than what we're able to allocate. And so all we ask is that if you, for example, want to commit an amount, let's assume it's $100,000, you shoot us an email, you shoot Laura a text, and you say, hey, put me down for this amount. I just want to make sure that I finish my due diligence. My attorney wants to review, or my IRA guy wants to see it, or anything like that, but put me down for that amount. If for whatever reason, during your search, during your period of time, you figure out that it's not for you for any reason, you just let Laura know, and then we'll pass along the opportunity to another person. Okay?
Yes, and then how long will the due diligence period be? I'm sorry.
So I would say, take a good couple of weeks, take 10 days, take a couple of weeks before you can feel comfortable. Funding will happen. And obviously, make sure that you're okay with our language in the operating agreement, which will be made available in 2 weeks' time. So only when you're ready to sign and deploy capital is when obviously capital is fully hard committed. We'll have 30 days, give or take 30 days, maybe a little bit more, maybe 40 days before we'll actually have to commit. But we would like to make sure that we know who we're working with, and that you're comfortable with it.
Terrific. Thank you.
Sure.
And Irv, I believe we have you now. Are you with us,
Yes.
Irv?
Yes, I am.
Hi, Irv.
Hey,
Hi.
Irv.
Okay, first of all, I want to thank Joe and Laura for always being available to me when I have any questions. You speak very highly of the South Side and, their net worth. Why would a company like that have to borrow at 19% when they can go to a bank? That's the only thing I don't understand.
Great question. It's kind of like a question of why we're in business. Consider the following. Our good old friend, Southside Joel Schwartz, essentially is buying deals all the time. I'm just looking for his portfolio. He's buying land all the time. We looked at his financials fairly recently, and we looked first of all to see how much capital he has in the bank. So he's not very liquid. He's got a lot of money sitting in a lot of bricks, right? In this particular case, think about this particular case. In September 22, they come in, they buy a piece of land, they use their own capital, $18.7 million. It's kind of like a big amount, $18.7 million. They work the property for over a year, going through permits and all the bureaucracies. They go into the ground. They start pouring cement and piles and everything else. And only at that stage, they call the bank. They call the bank like literally in October of 22. I'm sorry, they bought the land in 21, September of 21, in October of 22. So he's working with his own capital in most of the projects. He goes through all the red tape, finishes all this stuff, and then only then he calls in a construction lender. And at that stage, that's when he's, is kind of like tied with capital, and he's looking for partners. And so he can have two types of partners. Either he can have a partner that will come in with him, buy the building, stick around forever, will enjoy the cash flow, or he can get into a partnership like the way that we've designed, where he can take capital from us, pay a very high interest rate, okay, but for a short period of time, stabilize the property, refinance out, own the property 100%, pay us a very nice coupon. And so he prefers that methodology. He's got tons of buildings in comparison. He's got tons of building, and he wants to own as much of them 100% as possible. It gives us the opportunity because he's not very liquid. It maybe real estate rich, but not very liquid. We're providing liquidity for him to buy the next deal and the next deal and the next deal. And we're getting paid a very handsome penny. Now, we're not first position. Understand today, Irv, first position for a guy like that, it used to be 4 or 5%. Construction financing used to be 4 or 5% interest rate. Today he's paying 9.5. And so, it's kind of like a different world. It's a different world. So there's benefits and then there's drawbacks. The benefits to work with us is that, we'll stick around for a short duration of time. The drawback is we ask for a pint of blood because we like to give our investors great returns.
Okay, thank you.
You're very welcome. You're very welcome. I've been with us for a number of transactions together at this point, many years. In fact, many of the folks here have been with us for a good many years. It's kind of like the story of what we're doing here. It takes a while for folks to feel comfortable, to feel, that they can trust. Certainly it's not easy to send money to anyone. And that trust is something that gets to be built over time. And what we found is that people start slow, they invest a little bit, they try, and then they see the reports, and then they see the communication, and they see capital back, and then they see that they make good returns, sometimes a little bit better than what we anticipated, sometimes a little bit less. We don't control the markets, but they see great returns, and the trust gets to be built. And then they talk about this to their friends and to their family members, who gets curious, and that's how we grow. We grow organically. If there's no more questions, I know we're close to the hour at this point.
Joe, if you can just before we wrap up, if you can just touch on for 1 second that this opportunity is open to accredited investors only, or I can touch on it right now. This opportunity is open to accredited investors. I have dropped a link in the chat as to, if you're not familiar with that term, a little bit of a definition on our website for about that, but please do not let the term accredited investor deter you until we have had a proper conversation about it. You would be very, very surprised as to what makes you fall into a accredited investor status. Okay, so I just wanted to touch on that. We actually have two more questions from the audience.
Yeah, of course.
So give me 1 second.
Mm-hmm.
Adi?
Hi, Laura. Hi, Joe. How are you?
Hi, how are you?
Hey, Adi, how's it going?
Very good, Joe. Nice presentation. I missed the beginning, but I'm requested for a recording. I just wanted to just add my thoughts on that last question that was asked about that, why such a high return to the investor. It's generally, I come from a development background as well. And what we have seen is it is more expensive to have a equity partner in a deal forever versus pay a higher coupon for 3 years, 4 years, give them that coupon, get rid of those investors, get them protected, get rid of them. rather than giving equity to them and getting in bed with them forever, which is just
very true.
wanted.
Very true, and thank you for reiterating that. That's essentially the case. So the trade-off here: can will you pay a high coupon but short period of time, 2, 3 years, 4 years, and finish with this and hold the building 100% on your own for arguably forever, or are you better off paying a lower coupon or no coupon at all and have a partner that will you'll have to split profit with him for a very long duration of time. And so Joel Schwartz and many others, not everybody, but many others will prefer to have a structure like us, to pay the high coupon, knowing full well that they will own the property free and clear of all investors. Obviously, the remaining investor does always remain will be the local municipality and the bank, right? So that's what. Thank you for clearing that.
For the sake of the investors, I just want to put it on the record that I am an investor with Astor, and they've been very communicative. I did a 6-figure investment with them. Laura has been very communicative in terms of K1s reporting and things like that. Thanks.
Wonderful. Thank you for that. You see what's going on here. I don't have to sell Astor anymore. We have our own investors that are stepping in and are kind of like singing our praises. I really appreciate it, both Irv and Adi. I really appreciate it. The guys are pretty cool and really amazing. Thank you for saying that.
Me too.
We have Lloyd Fishman.
Lloyd. There we go, Lloyd. You are able to speak. How are you, Lloyd?
I'm well, thank you. Another longtime investor. Just to be clear, Joe, this is really more like a debt investment rather than an equity investment, right? You're paying coupons. There's no equity on the other side.
So I'm gonna explain it this way. So in between, sort of like the sandwich in between equity investment and pure debt, lies this animal called preferred. So preferred acts and walks and talks like debt. However, the developer, and certainly for the eyes of the bank, is not considering it debt. Now, in this particular case, we have about 40% of our portfolio is in fact in that specific hybrid between common equity and debt, that specific area. None of those carry a personal guarantee. So for all intents and purposes, I'm going to say, Lloyd, you're right. This is in fact debt. It's sort of like closer to mezzanine level debt than anything else. However, we are in the position of equity, and so we own 77% of the asset, 77.25%, I think, of the asset. It gives us the ability to collect before our developing partners. It gives us the ability to step in. It gives us the forced sale. We have all sorts of rights that owners of the land, owners of the asset has, and a debt does not have. So the remedies to how do we reach, in the worst possible day, the remedies of how we collect our capital are simply giving us a lot more muscle around it. But it's certainly right. It's a hybrid. Even from the eyes of taxes, we can treat it as capital gains, which is not something you can treat, debt structures, right? Debt structure, you're essentially ordinary income. It's interest income. In this particular case, we can claim it to be long-term capital gains. So even the tax structure here is favorable. So we really love this idea. The personal guarantee, certainly it's kind of like an added bonus that we have.
Thank you.
You're very welcome, Lloyd. Always good to hear from you.
Okay, so unless we have any other questions, I don't believe that we do. I'm already getting those commitments coming in. So thank you everybody so much. I will definitely be in touch a few minutes post webinar, and consider yourself confirmed.
Very great. Thank you very much, everyone. It's the top of the hour. I appreciate your patience. Feel free to reach me. Feel free to reach Laura with your level of interest or questions. We're here for you. And we'll talk again soon. Take care, everyone.
Thank you so much, everyone. Have a wonderful evening, and we'll speak soon.
You work hard for your money. It's time to make your money work just as hard for you.
You will have a secure future if you were to use Astor.
Hi, my name is Raquel El Khadif, and I'm a realtor with Broker Nation Real Estate in South Florida.
Hi, my name is Elena. I'm originally from New York, now currently living in Miami.
First and foremost, I was looking for my investors for institutional level investment. And the beauty of Astor is that an investor can come in with relatively a small amount of money and still be part of a big project with high returns.
Over the years, I've had many experiences with investing. I've learned so much, and approximately 5 years ago, I ran into a company, Astor, and found that they completed my investment approach. They are so selective with their projects.
The returns that they project are always high, but the track record is even higher than that. So it's kind of an element of under-promising and over-delivering, which I liked, of course.
Just based on years of trial and error and other companies that I've invested with, that they are far superior to all the other options that I've tried.
And it gives me and the investors some peace of mind.
I like that with Astor, I can sit back and have my money working for me.
They attract seasoned developers.
Feel very safe and secure with my investments with them.
I fell in love with them.
And I only use them now for my investments.
You guys made us feel like we're part of the family, and I thank you for that.